Okay, so we have supply and demand for dollars against the euro, and again we want a higher price, meaning a more valuable dollar. So if we're in the market for dollars, it's going to be per dollar. And when the dollar is more valuable, people are more likely to sell dollars and they're less likely to buy dollars. Because now when the dollar gets stronger, things priced in euros have become relatively more attractive. So you want to be a seller of dollars or a buyer of euros, or in other words, you want to buy fewer dollars because you want to go buy euros instead. Okay, so what's going to shift this curve? So let's do a demand shift as an example. And basically you can have the same reasons for shifting either supply or demand here, because either you're buying dollars selling euros, or buying euros selling dollars. So it's really kind of two sides of the same coin in this market. So what could make you want to buy either a dollar or a euro? So anything that would cause you to want to be in one currency versus the other. So relative prices. So if things are relatively more or less expensive in one currency versus the other. So let's just say that for some reason things have become more expensive in the US or less expensive in Europe, then I want to go buy things in Europe. So let's say we start with that relative price change, and now I want to, well, in this case, I did a dollar increase in demand. So let's say that people want to buy dollar goods, right? So let's do the other way around first. So prices are relatively lower in the U.S. in this case because people want to move into dollars, right? So things got cheaper in the U.S. for some reason. And so that means people want to be in dollars, want to buy dollars. And if you're buying dollars, you're selling euros. So this is the dollar market. So we're showing it as an increased demand for dollars. All right, so relative price change in one of those places. Now the asset side, so this is like goods and services, let's say, but we could also have assets. And one thing that would make assets relatively more or less attractive would be the interest rate. So let's say, other things being equal, interest rates are higher in the US, so that means if you go buy US assets, you can earn that higher interest rate. Well, dollar assets are more attractive, and so I want to increase my demand for dollars. So basically anything that makes either goods or assets relatively attractive. So it's always, since we're talking about dollars versus euros here, it's always relative, one versus the other. So if the prices of both things went up by the same amount, then in terms of the currency market, there's no change there. But if one becomes relatively more attractive, so price interest rates are often two of the big ones, but it could be risk changes for assets. That could be a change that makes them relatively more attractive, or possibly expectations about the future price of something, either goods or assets, could be a shift as well. So anything that causes you to want to be in dollars versus euros, and again, ultimately comes down to goods or assets, goods and services. When I say goods, I mean goods and services, or some kind of asset that's priced in dollars. And supply shift would basically be the same thing. So why would I want to get out of dollars, right? Well, I want to get into euros. So it's basically the same idea. Or if I'm less likely to sell dollars via supply decrease, well, why would I want to do that? I want to stay in dollars. I'm less likely to buy euros. So it really comes down to the same thing, whether we're shifting supply and demand in this market. So we can now compare, if we're going to graph the euro market, or I should say from the perspective of euros rather than dollars, then we'd want to do dollars per euro. Because if we're talking about euros, then we want a higher price to mean a more valuable euro. So the more dollars you can get for your euro, the more valuable a euro is. So these markets are really just the flip side of each other. These aren't two separate markets. They're the same market, because I'm just exchanging dollars for euros and vice versa. So if I'm buying dollars, then I'm selling euros. And so the exchange rate goes from 2 to 3. Well, it's going from a half to a third. It's the exact same exchange rate. So if the dollar is appreciating, it must be against the euro, then it must be that the euro is depreciating. So normally when we do a shift from one to the other, I'll usually do buying of one currency and selling of another currency, but it doesn't necessarily have to be that way as long as you're moving out of one and into the other. So just a reminder, depreciation of your currency, your goods become relatively cheaper. appreciation of your currency, goods are relatively more expensive. So key thing to always keep in mind when we're talking about exchange rates. So here, let me just finish drawing these graphs. So you could always do shift either side depending on which direction you're moving in. So if we wanted to move into dollars, then we could have a demand increase in dollars. But that also means you could also think of it as less likely to sell dollars. People want to be in dollars, then the supply of dollars could also be decreasing. So basically, as long as you're moving in the right direction, it doesn't really matter. You could always do a double shift like this if you wanted to. This is why we're not really too concerned about quantity, because I could have just kept the quantity the same if I wanted to by just doing a double shift like this. So if I'm more likely to want to be in dollars, I could be doing a demand increase or a supply decrease, and that means I am getting out of euros, right? So did I put my demand thing? There we go. So I'm decreasing demand for euros. So here I started here. But that also means that I'm more likely to sell euros. So I could be doing a demand, as long as I'm causing a depreciation of the euro, that I'm moving in the right direction. I'm getting out of euros and I'm getting into dollars. So I'm causing a appreciation over here and a depreciation over here. Now, to keep things simple, normally, like I said, I would, if we just go back to my other graph here, I would always do which currency are you buying and which currency are you selling. So just in most cases, you just need to do one shift unless they specifically ask you what's going on the supply side in this market. When people are moving into dollars or less likely to sell dollars, then I'd want to do a supply shift. Otherwise, I'm buying dollars, I'm selling euros. So it's kind of just easier to do that way. And then I'm not really too concerned about this quantity change because I'm just showing basically this particular shift into dollars, out of euros. So which currency are you buying? Which currency are you selling? That's the way I normally think of it. So we can usually ignore the double shift happening there. Okay, now something you have to keep in mind when we're dealing with currencies is sometimes cause and effect can kind of be switched around here. So we might start with something causing a relative price difference, a relative price change between these countries or these regions. So let's say that for some reason prices are cheaper now in the US relative to Germany, let's say. And that causes people to want to buy dollars and to want to sell euros, correct? Because I'm going to go buy dollars in order to buy dollar goods. And so that relative price change is causing the change in the exchange rate. But you could also start it the other way around, and you could say something caused the dollar to appreciate here. People are buying dollars maybe for some other reason besides the relative price of goods. And so now you're starting with an appreciation. The appreciation changes the relative attractiveness of goods, because now remember, when I go to make that exchange, if it takes me more euros to exchange with a dollar, then that changes how cheap or how expensive things are in the US versus the euro. And so that changes people's buying behavior and therefore changes relative prices, right? So here we started with that relative price difference that led to an exchange rate change. We could start with the exchange rate change leading to that relative price difference. So it just depends on what scenario we are thinking about here. So now going back to the current and financial accounts. So think about how these things have to balance. So in my example, I had the US importing from Germany. Well, in order to do that, you're getting out of dollars, you're buying euros, right? So in terms of the dollar market, I would look at that as selling dollars. I'm getting out of the dollar and I'm going to go buy euros. So I'm just showing the dollar side of it. And so now remember what happens, the flip side of that trade deficit or that current account deficit with Germany is that I'm going to have money flowing into the US, financial account surplus, from the point of view of the US. Well, think about what happens. So like I said, we're selling dollars, which means the dollar has depreciated. Now when the dollar depreciates, things that are priced in dollars become relatively more attractive, right? And the euro is the flip side of that. So the euro is now getting stronger. And so assets or goods that are priced in dollars have now become relatively more attractive. Now I assumed that we started with this trade deficit here. And so it's going to be balanced by this financial account surplus. And the way that happens is that assets that are priced in dollars just became more attractive when that dollar depreciates. Because when I go to exchange euros, took me half a euro to buy a dollar now it takes me a third of a euro to buy a dollar. So when I go to buy a US bond, for example, well, now it's cheaper. And so that adjusts enough so that this account has to balance, right? So Germany is now buying US assets, which have become relatively more attractive due to the exchange rate change, and that has to basically adjust until those two sides are balanced, just like any other market that we are looking at. And we started with goods here. We can do the same thing. We start with assets. So for some reason, people decide they want to buy U.S. assets. Well, that causes the dollar to appreciate, and then that makes U.S. goods relatively more expensive. And so the flip side of that is that will affect the trade balance. And so again, you can see how these things are interrelated.